Why are Canadian retailers turning their backs on American goods? A new underground wave is emerging in North American commerce. The Buy Canadian movement. This is no longer just a catchphrase, but a real movement spreading from big cities to small towns, from supermarkets and convenience stores to giant retail chains. Shelves once filled with American products are being stripped and replaced with Canadian goods. According to the latest Ledger survey, more than 71% of Canadian consumers declared they prioritize domestic goods over imports from the United States. This figure far exceeds the average of previous years, when only about 45% of Canadian consumers expressed support for domestic goods. This is no longer a random choice, but a powerful political and economic statement sent directly to Washington and cross-border corporations. The impact is tangible and clear. U.S. product sales in Canada have dropped by nearly 30% within a single year, an unprecedented shock in the history of bilateral trade. American brands that once dominated the market from food to beverages to agricultural products are now at risk of losing their foothold. This shift is more than just consumer behavior. It is turning cross-border supply chains into a literal economic battlefield. Every truck, every export contract, and every warehouse along the border is now on red alert for U.S. corporations. It is a warning that billions of dollars in revenue could disappear in a wave of emotional but extremely fierce consumer choices by Canadians. Let's take a closer look at the issue with the Globe Choa's insights to see how this earthquake is shaking up the entire North American trading system. According to data from the Retail Council of Canada, U.S. product sales in major Canadian retail chains have declined by nearly 28% in just 1 year. This is not a small change in the retail industry, but a real shock when dozens of American brands that have been deeply rooted in Canadian consumer life are suddenly pushed out of the game. Step into any Canadian supermarket today, and the change is obvious. Products that were once considered untouchable on the shelves, Kellogg's cereals, Pepsi or Coca-Cola soft drinks, American snacks from Lay's to Doritos, are gradually disappearing. Instead, consumers are seeing more and more brightly colored packaging printed with the words "Proudly Canadian" as an affirmation. These are Canadian products made by Canadians for Canadians. The country's three retail giants, Loblaws, Metro, and Sobeys, have publicly announced a new strategy prioritizing domestic goods, expanding shelf space for domestic products, and gradually reducing import contracts from the U.S. But when the giant retail chains made that decision, the chain effect spread immediately. Small convenience stores and local supermarket chains were also forced to change their import policies if they did not want to be seen as going against the booming trend. This has left a series of American suppliers isolated. Previously, if they could only squeeze into a large Canadian retail chain, American products would immediately have a solid foothold, easily covering the whole country. But now, that door has almost slammed shut. Many long-standing distribution contracts were even terminated immediately, leaving American businesses scrambling to find alternative outlets in desperation, which were used to stock and distribute American goods, are now in a state of surplus. Many shipments are forced to be re-exported or even destroyed. The disruption not only causes financial damage, but also puts enormous pressure on cross-border transport systems, which are already facing a decline in cargo traffic. According to the USDA, U.S. agricultural exports to Canada have fallen by more than $19 billion, the lowest level in 15 years. This is a red flag, as Canada has long been the third largest agricultural export market for the U.S., behind only China and Mexico. The loss of such a huge output is like a blow to the heart of U.S. agriculture. The hardest hit commodities are soybeans, corn, and beef products that have been heavily dependent on the purchasing power of the Canadian market. Last year, U.S. soybean exports to Canada alone were valued at over $4 billion, but that figure has now dropped by nearly half. Beef and corn are in a similar situation. With a series of contracts canceled or not renewed, products that were once the trump cards in U.S. agricultural trade are now being pushed aside, making way for domestic supplies from Canada. This has put American farmers in an unprecedented predicament. The American Farm Bureau Federation warns that more than 125,000 jobs in the agricultural sector are at risk of being lost entirely if this trend continues. The Midwest states, considered the grain basket of the United States, are suffering the heaviest losses. In Iowa, Illinois, Nebraska, and Minnesota, agricultural warehouses are filled with millions of tons of soybeans and corn that cannot be exported. This huge inventory is pushing agricultural prices down, causing farmers' incomes to plummet. Even many households are facing the risk of bankruptcy. Meanwhile, Canada has acted extremely quickly and methodically. The Ottawa government has not only increased direct financial support for domestic farmers, but also promoted massive promotional programs with a message "Eat homegrown food." That, as a result, which in turn reduces demand for fertilizers, machinery, and agricultural services, that a chain of damaging dominoes is spreading from fields to factories, from farmers to food processing corporations. A new shock is spreading to the processed food and beverage industry, a sector that has long been considered a U.S. strength in Canada. Imports of U.S. wine and beer have dropped by more than 35% in just 1 year, marking the steepest decline in the past 2 decades. American brands that once dominated the market, from Coca-Cola and Pepsi to Jack Daniels and Budweiser, are losing ground. Bottles of American soda and cans of beer that were once ubiquitous in Canadian stores, supermarkets and bars are now being rapidly replaced by domestic products. Consumers are choosing Niagara wine or Canadian whiskey not just for quality, but for sentiment. It is a clear endorsement of Made in Canada. The picture at liquor stores in Ontario and Quebec illustrates this more clearly. The American product aisles are increasingly empty. While domestic brands are constantly being replenished, Canadian beer sales have risen by nearly 20% in just 1 year, while Niagara wine recorded record growth, surpassing even long-established imported wines. Consumers are sending an unmistakable message. American goods are no longer the default choice. The impact on American companies has been devastating. Many breweries and soft drink makers in states such as Tennessee, Kentucky, and Missouri, which rely heavily on the Canadian market, have been forced to cut production. Major corporations have reported billions of dollars in lost revenue, leading to thousands of layoffs for some small and medium-sized businesses with only 1 or 2 export markets. The blow could mean total bankruptcy. The longer-term danger is greater. Once consumers have developed a habit of drinking Canadian beer instead of Budweiser or Canadian whiskey instead of Jack Daniels, the likelihood of them switching back to American products is slim. This shift affects not only a few individual brands. The flow of trucks carrying American goods to Canada has plunged by more than 22% in just 1 year, marking the most severe decline since the financial crisis of 2008. Trade routes that are considered the lifeblood of the North American economy are now in a state of prolonged congestion. Convoys of trucks have been waiting for hours, even days at ports, such as Detroit, Windsor, Buffalo, Fort Erie, and Peanut, Emerson. The image of endless lines of U.S. trucks has become a symbol of the stagnation of cross-border trade. Busy ports and warehouses are also in a similar situation. Each day, experts estimate that the U.S. transportation sector loses between 8 and 10 million, a figure unprecedented in the history of trade relations between the two countries. Meanwhile, the picture on the other side of the border is completely opposite. Canadian logistics companies are taking advantage of this crisis to restructure their transportation chains. They are shifting their focus to domestic distribution while expanding strongly into European and Asian markets. The latest data shows that revenue for Canadian logistics companies has grown by more than 12% over 6 months. While the U.S. has suffered widespread declines, a quiet but drastic shift in the balance of power is taking place. Canada is strengthening its position as an international transit hub, while the U.S. is gradually losing its competitive advantage right on its own border. The consequences are not limited to road transport. Rail lines have also seen record drops in cargo volumes, especially agricultural products, steel, and chemicals. Union Pacific and BNSF railroads, key pillars of North American transportation, reported nearly a 15% decline in revenue from Canadian contracts. In the big picture, the United States is losing its role as the hub for North American supply chains. Canada has not only built an independent logistics network, but has also begun to attract foreign investors who have traditionally favored the U.S. market. If this trend continues, the United States risks being excluded from the very trade vortex it has led for decades. The boycott of American goods in Canada has not only stopped at the commercial level, but has also spread to the political and bilateral relations fields. The latest survey shows that up to 68% of Canadians firmly support the government in continuing to tighten trade with the U.S. Even as diplomatic tensions escalate and the risk of political confrontation becomes increasingly evident, the Buy-Canadian movement, which started as a short-term call, has now gone beyond the economic level that it is gradually becoming a part of the Canadian consumer culture, where people see choosing domestic products not only as an economic act, but also as a symbol of national pride on forums, social networks, and even in community communication campaigns. Supporting Canadian products has been raised to a nationwide social movement. Many experts say that this picture is gradually forming a new economic wall, dividing the North American market. This is a historical paradox when, not long ago, the USMCA agreement was praised as a symbol of regional economic integration, opening an era of barrier-free cross-border trade. But the current reality shows the opposite trend. Canada proactively erected a new barrier, weakening the cooperative structure that was once considered the most solid foundation of the region for the U.S. The North American trade landscape could enter a new era, an era of separation rather than integration. Canada has built an economic wall no one thought possible, forcing American goods that once filled Canadian supermarkets, powered factories, and sustained farms to retreat in defeat. From dairy and wine to gasoline and industrial products, entire sectors are caught in a downward spiral. Millions of U.S. workers are now on the edge, and thousands of businesses face cutbacks or bankruptcy. But while America scrambles, Canada is seizing the moment, reshaping its domestic market, boosting local production, and forging new global trade ties. This is more than economics. It's politics, diplomacy, and the future of North America itself. Canada is no longer living in America's shadow. It's carving its own path, and with every move, the old balance of power is slipping away. The U.S. has paid a historic price, the collapse of an advantage once seen as untouchable. And here's the real question. Is this just a trade dispute or the beginning of a new world order in North America? Tell me what you think in the comments below. And if you want to stay ahead of these global shifts, don't forget to like this video, hit subscribe, and join the conversation.